Welcome to Tesla Daily News Podcast for Thursday, April 23rd, 2026. Today we're tracking Tesla's earnings setup, a big push in India, and several legal and regulatory headlines that could move sentiment and, ultimately, the stock. Let's start with the big event risk. Tesla reports after the close today. Here's the hook. The entire tape is watching whether Tesla can prove the core auto business is stabilizing while it funds the autonomy, AI, and robotics story. Context. The market has been rotating back into mega-cap tech, and Tesla is the first of the Magnificent Seven to report this cycle, so it sets the tone. Details. Going into earnings, Tesla reported first quarter deliveries of 358,023 vehicles, below some expectations, while production exceeded deliveries by about 50,000 units. Wall Street models circulating in today's coverage cluster around roughly $21 to $22 billion in quarterly revenue and about 30 cents of non-GAAP earnings per share, with some forecasts also pointing to weak or even negative free cash flow. Impact. Any commentary on automotive gross margin, pricing, and inventory will likely matter more than small beats or misses. With oil volatility in the background, risk assets are already jumpy, so Tesla's guidance and tone can swing the stock fast. Takeaway. For investors, this is less about one quarter and more about whether management can show credible progress on autonomy and robotics without letting the vehicle business erode. Next story. JP Morgan is sticking with an underweight stance. Hook. One of the street's more skeptical voices is effectively saying, the estimate cuts aren't new, and the trend is the problem. Context. Tesla's valuation depends heavily on future growth and software-like margins. When earnings expectations ratchet down for years, the multiple becomes harder to defend. Details. JP Morgan notes that analysts have reduced first quarter 2026 earnings per share assumptions by about 78% on average since June 2022. Impact. Even if the stock rallies on AI and robotaxi narratives, persistent estimate compression can cap upside and keep institutional positioning cautious. Takeaway. Watch not just Tesla's numbers tonight, but the forward-looking language that influences next quarter and next year estimates. Now, a major operational and growth narrative, Tesla's India expansion and the launch of the new Model YL. Hook. Tesla is trying to buy its way into India the same way it won other markets. Ecosystem first, volume later. Context. India is still a small EV market by penetration, but it's one of the biggest long-term unit opportunities in global autos. The barrier is infrastructure, service coverage, and pricing friction from import duties. Details. Tesla launched the three-row, six-seat Model YL in India at about 61.99 lakh rupees. Tesla India leadership also said the company has already enabled 5 supercharger stations and plans to expand service and body shop presence into cities, including Bengaluru, Hyderabad, Chennai, and Ahmedabad. On charging, Tesla says it intends to connect major city corridors such as Delhi, Chandigarh, Jaipur, Ahmedabad, Pune, Bengaluru, and Chennai with superchargers on key highways, plus destination charging around major metros. Impact. In the near term, India likely won't move Tesla's global delivery numbers. But investors should care because infrastructure build-out is a leading indicator of intent, and it sets up future demand and higher margin services and charging revenue. The risk is that import tariffs keep pricing high, limiting volume until local production or a more favorable tariff regime arrives. Takeaway. India is a long-duration call option. The stock relevance is whether Tesla can scale profitably, not whether a premium Model Y variant sells a few thousand units. Staying in India, Tesla also signaled it wants to bring Optimus and potentially its energy business to the market. Hook. Tesla is explicitly marketing itself as more than a car company in India, with robots and energy as the next acts. Context. Tesla's bull case increasingly rests on non-auto segments, autonomy software, robotics, and energy storage. Any expansion pathway that grows total addressable market supports that narrative. Details. Tesla's APAC leadership said Optimus volume production is expected to start later this year in the United States, and that Tesla wants to bring Optimus to India at the right time. The company also pointed to its vertically integrated energy solutions, including solar and energy storage products like Megapack and Powerwall, as potential future offerings in India. Impact. The market typically discounts Optimus heavily until there is real unit volume, pricing, and margin visibility. But repeated volume production later this year, messaging raises the stakes for execution and could move analyst models over time. Takeaway. Listen tonight for any specifics on Optimus production cadence, bill of materials, and initial internal deployments. Vague promises won't move fundamentals, timelines, and unit economics can. Next, a U.S. demand warning sign, California registrations. Hook. Tesla registrations in California reportedly fell sharply year over year, and that's a headline investors cannot ignore. Context: California has been Tesla's flagship U.S. market, both for brand strength and EV adoption. Weakness there can signal broader demand pressure, especially as incentives change. Details: the California New Car Dealers Association data cited in coverage points to a roughly 24.3% decline in Tesla registrations in the first quarter of 2026. The same reporting notes overall zero-emission vehicle registrations in the state also dropped sharply year over year. Impact: if Tesla's strongest domestic market is down materially, investors will worry about price elasticity, competition, and whether recent product refreshes are enough. It can also pressure near-term margin if Tesla leans on incentives. Takeaway: tonight's call needs to explain whether this is incentive timing, product cycle timing, or true share loss. Now, legal and regulatory risk. Europe is seeing new pressure around full self-driving hardware. Hook: Tesla faces the risk that older vehicles may not get the FSD experience customers expected, and that can turn into mass claims. Context: FSD is not just a feature, it's a deferred promise that underpins Tesla's software narrative. Hardware fragmentation, like Hardware 3 versus newer platforms, creates both cost and reputational risk. Details: a report highlights an organized effort in Europe to pursue a broad claim focused on Hardware 3 owners after a European approval milestone for FSD that appears to rely on newer hardware. Impact: if claims scale, Tesla could face refunds, retrofits, or settlements. Even if the per-vehicle amounts are modest, the headline risk can pressure the multiple because it hits the software upside story. Takeaway: watch for any disclosure around the cost and feasibility of hardware upgrades and how Tesla plans to manage expectations in markets with new autonomy approvals. Related legal overhang: Norway's long-running Model S battery update dispute. Hook: Tesla has been ordered to compensate some owners after a software update allegedly reduced range and slowed supercharging. Context: Tesla's software-first approach is a competitive advantage, but when updates change performance characteristics, the downside is regulatory and legal exposure. Details: the case involves Model S vehicles from model years 2013 to 2015 with the 85 kilowatt-hour battery pack tied to a 2019 software update intended to improve battery longevity and safety. Owners reported reduced range and significantly slower supercharging. Impact: financially, this probably won't be massive relative to Tesla's scale. But it reinforces an investor risk. Software changes can create liabilities, and that can factor into warranty accrual assumptions and brand trust. Takeaway: Tesla's long-term advantage is software, but investors should track how courts and regulators treat over-the-air changes that affect paid-for performance. One more story that matters for Tesla's competitive positioning: charging speeds are moving fast outside the supercharger network. Hook: ChargePoint just introduced a new 600 kilowatt fast charger, highlighting how quickly the industry is pushing power levels up. Context: Tesla's superchargers are still the most reliable network in many regions, and the company has been opening NCS as a standard. But pure charging speed and throughput matter for consumer perception and fleet economics. Details: the new ChargePoint unit can deliver up to 600 kilowatts, potentially splitting power across two vehicles, and it supports both CCS and NCS via an Omni connector. Impact: faster third-party charging can reduce Tesla's network differentiation over time, especially as more automakers adopt NCS. Tesla can still win on reliability and density, but investors should watch whether supercharger capital spending keeps pace. Takeaway: charging is becoming a feature race again. Tesla needs to maintain network leadership while also managing capital efficiency. Closing recap. The big themes today are earnings risk tonight, India as a long-term ecosystem build, and rising legal and regulatory noise around batteries and autonomy hardware. For Tesla, the stock reaction will likely hinge on margins, demand commentary, and whether Tesla can add real, measurable milestones for Robotaxi and Optimus. For tomorrow, watch for the market's post-earnings digestion, changes to price targets, estimate revisions, and any new details on autonomy approvals in Europe and fleet expansion plans. If you found this helpful, subscribe to Tesla Daily News Podcast and follow us for an investor-focused recap every trading day.